Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Shenzhen Dobot Corp Ltd. Annual Report. Shenzhen Dobot Corp Ltd. offers a wide range of businesses and services related to collaborative robots, also known as cobots. The company's product lineup includes 6-axis cobots under the CR series and Nova series, designed for various industries such as manufacturing, retail, and healthcare. Its 4-axis cobot series consists of Magician series and M series, primarily used for desktop-level use cases and light manufacturing processes. The company also provides integrated cobots for palletizing, welding, mobile operation, and vocational training. Additionally, it offers an AI-empowered cobot platform, Xtrainer, which enables data collection, low latency, and generalized learning systems. Shenzhen Dobot Corp Ltd's products cater to various industries, including manufacturing, retail, healthcare, STEAM education, and scientific research settings. The company's Magician series is designed for educational institutions, assisting students in STEAM curricula, while its M series includes 4-axis cobot models for light manufacturing. Overall, Shenzhen Dobot Corp Ltd. provides a comprehensive range of collaborative robots and services to various industries, making it a prominent player in the market. Shenzhen Dobot Corp Ltd. maintains a market capitalization of $14 billion, broadly in line with the industry peer group. Shenzhen Dobot Corp Ltd. trades at a higher price-to-book ratio of 11.46 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company maintains a moderate leverage profile, with liabilities making up 35% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have increased consistently as the company expands. Importantly, both assets and shareholder equity have grown at least 20% faster than liabilities, indicating that the business is expanding substantially and generating value after covering its obligations. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The share count has remained broadly unchanged, indicating no significant dilution or buyback activity over the past 5 years. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The company comfortably covers its interest expenses through operating income and maintains a strong cash position relative to current liabilities. Additionally, special charges appear non-recurring, suggesting high earnings quality and strong financial resilience. The primary drivers of revenue growth or decline can be identified through a thorough analysis of the extracted summary. On the revenue growth side, several key factors contribute to the increase in revenue. Firstly, the company's investment in embodied AI products and research and development has led to breakthroughs in various industries, including automotive manufacturing. The expansion into new markets such as Germany, Thailand, and South Korea has also contributed significantly to revenue growth. Furthermore, the launch of new products, such as CRAF and CR30H cobots, has been well received by customers, leading to increased sales. Additionally, the company's deepened presence in small-batch, multi-variety production processes has resulted in higher revenue. The growing demand for educational robot products and solutions has also contributed to revenue growth. On the other hand, there are several factors that have led to a decline in revenue. One of the primary drivers is the decrease in 4-axis cobot sales due to strategic adjustments. Additionally, carbon tariffs policies and tighter regulations on high-emission manufacturing suppliers have increased production costs, leading to a decline in revenue. In conclusion, the company's revenue growth can be attributed to its investment in embodied AI products, expansion into new markets, launch of new products, and deepened presence in various industries. However, the decline in revenue is primarily due to decreased sales of 4-axis cobots and increased production costs resulting from carbon tariffs policies and regulations. The company's financial performance indicates a healthy trend. One key indicator of this is its ability to generate positive operating cash flow. This means that the company is producing more cash from its core operations than it is spending, resulting in a net gain. According to the provided information, this positive operating cash flow has been consistent over at least 2 years, as confirmed on page 251. The company's debt level has undergone a significant change in recent years. According to the data, the debt level decreased from RMB 217.8 million in 2024 to RMB 71.8 million in 2025, indicating a substantial reduction of approximately 67%. This decrease is also reflected in the current liabilities, specifically interest-bearing bank loans, which dropped by -64.4% from RMB 201,658 to RMB 71,831. However, there are conflicting reports regarding the company's interest expenses. While page 242 suggests a total interest expense increase of RMB 753, other pages do not consistently report this information. Furthermore, page 251 reports an increase in total debt by +155.6%, but this is likely due to the inclusion of new financial assets and liabilities. Despite these inconsistencies, it appears that the company's debt level has decreased significantly, while interest expenses have increased slightly. The exact percentage of the increase in interest expenses is unclear, but overall, the data suggests a notable reduction in the company's debt burden. The performance of various segments and regions in the market has been mixed. On a positive note, the Asia-Pacific market has shown significant growth, as have several industrial sectors such as automotive intelligent manufacturing, semiconductor and medical surgery, and small-batch production processes like 3C electronics and precision parts. The education market also performed well. However, some regions have struggled to keep pace with the overall growth. The Chinese mainland saw a relatively low revenue increase, suggesting that it may be experiencing some challenges. Overseas markets, including Hong Kong, Macau, and Taiwan of China, also experienced slower growth, with an increase in revenue of only RMB 41,834 from 2024 to 2025. Management's outlook on the company is cautiously optimistic. Despite administrative expenses increasing due to headcount growth, research and development expenses rose significantly by 59.7% as the company invests in core technologies and AI robots. This investment is expected to drive future growth. The decrease in net loss by 11.9% is a positive sign for the company's outlook. However, management acknowledges challenges such as limited operating history, uncertain growth and profitability, and difficulty obtaining additional capital on favorable terms. Management has also emphasized its commitment to environmental, social, and governance (ESG) initiatives, sustainable development, and climate-related risks. The company aims to create long-term positive impacts and maintain a leading position in sustainable development by reducing emissions, strengthening data quality, and adopting solar energy as an operational energy source. Overall, management's strategy is focused on investing in core technologies, reducing costs, and prioritizing sustainability, while navigating the challenges of limited operating history and uncertain growth. Concerns about inventory buildup or supply chain disruption are evident in the provided summary. On page 108, it is mentioned that flooding and heavy rainfall may disrupt operations, production, and logistics services in the medium term. Furthermore, on page 109, instability in raw material supply is anticipated during the supplier transformation period, which could impact production stability. This suggests a potential strain on the supply chain due to changes in suppliers. Additionally, inventory impairment loss has been identified as a significant issue on page 146, with the inventory turnover ratio compared to comparable companies within the same industry indicating potential problems. The increase in raw materials, work in progress, and goods in transit from 2024 to 2025, page 217, also raises concerns about inventory buildup. Lastly, on page 20, it is mentioned that increased sales volume of certain products may put a strain on the supply chain. These points collectively indicate potential issues with inventory management and supply chain resilience. That concludes the financial summary for Shenzhen Dobot Corp Ltd. Feel free to comment below, and I will be happy to answer them when possible.